if we don't have a recession, if we don't have a credit crisis, we are going to have a blow up in the bond market just because we have so much fiscal and monetary madness going to happen in 2026. And I think if those bond yields go north of 6%, I think that completely submarines the housing market and completely blows up the credit bubble, obviously, and also the equity bubble.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When today's guest was on this channel earlier this year, he warned that a triumvirate of three massive asset price bubbles in credit, real estate, and stocks threatened to take down our fragile economy and dash the retirement hopes for millions. But since then, the bubbles have only expanded. So, will they expand further or pop in 2026? To find out, we've got the great good fortune to welcome money manager Michael Pento back to the program. Michael, thanks so much for joining us today.
Hey, I'm looking forward to a great conversation, Adam.
It is always a great conversation with you, Michael. I'm looking forward to this too. Lots to talk about. Not a lot of time, so we're going to have to just bang through a bunch of stuff as quickly as we can. So let's start here. So the day we're recording, Michael, it's Friday. Yesterday, Thursday, market close, record high for the S&P and for the Dow. Kind of riding a recent sugar rush with the recent Federal Reserve guidance and Chairman Powell talking about how the Fed is going to be buying $40 billion worth of T-bills going forward. Markets interpreting that as QE light or maybe just regular QE. So anyways, you've warned about these bubbles. They seem to continue being blown here. Let's start there. As we look into 2026, is it just going to be more of the same, or do you think there'll be a reckoning at some point next year?
Okay, so if you don't mind me answering the question this way, so let's just go back on a timeline. So my IDEC model on November 6th said it was time to get a little more defensive. So we started the year bearish, as you remember, cautious. April 2nd was Liberation Day. April 9th was we recanted all of our Liberation Day tariffs, or most of them, at least the levels. And then we went bullish, and I've been on your program several times saying that we're not max bullish, but we were 40% long the market until November 6th. That's when the IDEC model began to tell me, hey, start getting more defensive, and I did. And the reason why, I'm glad you're having me on, I want to walk the audience through what I saw and what I see now, and then we can talk about 2026. So I noticed that on November 6th, financial conditions stopped easing, and credit spreads began to widen out. So that had me thinking, well, why would that happen? Is it just a fluke, or is the move substantiated? So then I looked at the reverse repo facility, which effectively is zero. These are the liquidity metrics that I look at. The level of the real Fed funds rate had been in positive territory for 2.5 years, which in previous cycles indicated it was time to get bearish, because that's when you'd have a sell-off in the market. Bank reserves had been falling for the past few months, and the slope of that line was increasing to the downside. And the yen carry trade, again, there'll be slides on this stuff later in the show. The yen carry trade started to erode significantly, which is basically, just real quick, people, mostly institutions, borrow in yen, they sell the yen and buy various currencies across the globe, their bonds and their stocks, and they get a much higher yield. And they also get a currency appreciation with that too. When they repatriate back into yen, the yen has usually declined. It's a huge source of liquidity, and that has dried up, or it was drying up. Then I look at some AI credit default swap spreads, in particular Oracle, and they were blowing out. And the last thing I looked at in my model, these are all things in my model, was the MOVE index, which is a measure of bond market volatility. That was spiking. So for those reasons, I sold down the equity exposure from 40% to just 15% net long. Then on November 13th, the Fed funds, this is before November 13th. So the model is very, very robust. I picked up on this trouble before. November 13th is when the Fed funds futures market said that there would not be a rate cut in December. it went below 50%.
Yep.
And in that 1 week between November 13th and November 20, was it November 21st that I emailed you? I think it was November 21st. The S&P dropped 5%, the Qs dropped 6%, and Bitcoin went down by 20%. So everything went to an R squared correlation of 1 in that week. Everything planned. Even silver and gold was being sold off.
Yep. And I just checked. It was November 21st when you
Okay.
emailed me about that.
And on November serendipity for me, when I told you that I had been selling on November 21st, New York Fed President John Williams came out of the blue. Maybe not so much, Adam, but maybe out of the blue, said, "Oh, by the way, we are going to cut rates in December." And the Fed funds futures market went to 90% that we were going to have a cut. And then, of course, on December 10th, Jerome Powell proved himself one of the great alchemists, one of the greatest counterfeiters in history. Not only did he cut rates again by 25 basis points, but yes, he entered into a $40 billion per month QE program. Now, some people are saying that's not QE. I would argue that till I'm blue in the face or dead, because when you expand the Fed's balance sheet, when you print money ex nihilo out of nothing, and you're buying short-term bonds, I don't care why you're buying them. I don't care if you're buying them to bring down the rate or keep money market rates stable to hit your target. You are expanding the Fed's balance sheet by creating money out of nothing, credit, high-powered money. Fed credit is the same as cash. It's electronic cash. It can be converted to cash. That's why it's part of the high-powered money aggregate. They're blowing that up by $40 billion a month. So yes, we are in QE. And that has put a lid on the deterioration of financial conditions and sent credit spreads into a period of mollification. They were being mollified as of this recording. And then we have today, we see some, I think my theory is it has more to do with the AI bubble bursting, and we can get into that later in the program. But there's two salient risks for 2026, and one of those risks is the AI credit bubble is going to burst, and so that's what I think is happening today. But that's where I was. That's a recap of 2025 in a nutshell.
Okay, and for folks that they're going to watch this a couple days after we record this, Michael, but who weren't paying attention this Friday that we're talking, what about today's action is making you think that the AI bubble may be starting to break down?
Well, we had earnings out on, I believe it was what was the big AI company that came out on Avago, right?
Okay.
AVGO. And they said they beat on the top line, they beat on the bottom line, and then it turns out it looks like financial alchemy on their balance sheets. That's what people are seeing right now. In other words, this circular financing and there's all kinds of, and this is I'm not a forensic accountant, but they are being accused of accounting gimmickry, and that's why the stock is crashing and is bringing down the whole market with it. Because listen, Adam, if you take out AI from earnings, look at the NIPA tables, earnings are falling. So if you take out the AI stocks from the earnings complex, EPS is dropping on the S&P 500. And if you take out the companies that deal with AI, you don't have much of a gain in the stock market. And you don't have much of a gain in GDP either. It's all about this financing of the AI bubble, which used to be, was the foundation was built on cash flow, and now it's borrowing hundreds of billions of dollars to buy these chips. So it's just another example of this magnificent credit bubble, which is part of the triumvirate of bubbles that include equity prices and real estate.
Okay, and I want to note too this week that Oracle suffered a big drop, and largely I think because its capital expenditures on AI were even bigger than what Wall Street was expecting. And I know Oracle, they've had a lot of questions about, man, is this company going to actually be able to finance what it's told us it wants to build out here? So anyways, there does seem to be sort of a questioning of confidence in the space that we're seeing this week. I think Broadcom also had a similar
Well,
size sell-off, that
AVGO,
13%, something like that.
yeah, that's what I was trying to get out of it.
Oh, Broadcom. Okay,
Broadcom,
yeah.
as the symbol is AVGO for Broadcom.
Okay, yeah. Okay. So we're seeing some very big players, and folks may remember Oracle added a ridiculous amount of market value at its last earnings call because it was announced it was going to do all this spending for AI, and this big blue chip tech company, added like 40% of market value within a matter of hours. I think we're starting to see the bloom coming off that rose. So, is this the end of the AI bubble? I don't know, probably too early to tell, but definitely these are some of the initial signs you might expect to see. So more to come. Okay, so you just recapped 2025 for us. You gave a quick mention to some of the slides that you prepared, Michael. Because we are a little tight on time, I want to make sure that we get to them and we don't shortchange them. Should I pull them up now?
Sure, go ahead.
Okay.
Put a little color on more of what my model looks at and what I was seeing and why I was able to shed some of the high beta exposure before we had that big swoon. The S&P and the Qs, everything was dropping. Interesting, as my theory holds again, and it's proven out that everything goes to a correlation of one. When you see this, rapid disinflation or deflation or some kind of chaos in the bond market, which I will talk about 2026 too. So first, the first slide is it's just a chart of the real Fed funds rate, and in particular, you can see that the level of the real Fed funds rate has been positive for 2.5 years. That's the very right side of the chart. And that's most relevant because it was mostly negative. We had a negative real Fed funds rate from 2001 all the way to 2022. And you could see what happened right before 2008. You see the real Fed funds rate spiked up about 2.5 years, and then we had a collapse in the credit markets, the housing market, and in the stock market. So my model here looks at also bond market volatility. This is the MOVE index. This is from Merrill Lynch. And you can see just on the right side of the bond market volatility started to spike in very, very early November. And that was another reason why I went a little bit shorter on my exposure with equities. It's since come down a little bit, but it's spiking back up again. Reserve balances, bank reserves have dropped $1.2 trillion since 2021. Now, what makes reserves disappear? Two things. Quantitative tightening is one, and the other one is bank runs. When you go to a bank and you take money and you withdraw it, their reserves are drained. And look at this precipitous slope over the last few years here since 2021. And that's what, if you're ever, we can talk about it ad nauseum. I know we're short on time, but if you want to ask yourself why, after almost 5 years of missing your inflation target to the north, that you would dare to cut interest rates for the third time in this, 3 meetings in a row, it's to protect banks and to keep interest payments low for the Treasury. Those are your two. It's not about the middle class. It's not about employment. It's that those are straw men. They are reasons to obfuscate the truth. They are in business to protect banks and to make the Treasury solvent, and that's the only reason why. That is the main reason why. Believe me.
And Michael, there's a term out there called fiscal dominance, and in a nutshell, it basically means you get to a point where the central planners have to kind of abandon any and all other mandates that they have, price stability, unemployment low, whatever. They have to sacrifice it all just to keep the debt serviceable.
Yeah.
In your opinion, are we mired in fiscal dominance now?
Yes. When you have $1 trillion in interest payments, that was the watershed moment where I think that's the only cogent, reasonable assertion you can make, because looking at all-time highs, you just mentioned all-time highs in the stock market other than today. Financial conditions are still pretty easy. You have an unemployment rate that's way below his historical average. Home prices are unaffordable for most Americans, and you've missed your inflation target for almost 5 years. if I just mentioned all those things, which are all facts, they're not my opinion, they're all facts. You would say, well, the Fed is raising interest rates. They're not cutting. They're not cutting 3 times in a row and going back into QE and being told by the administration that they should have went by 50 basis points, if not more. It's all about keeping debt service costs low and keeping banks solvent.
Okay.
It's not about the middle class, unfortunately. So on slide 4, you see these are the reserve balances. I just talked to, no, that's slide 3. Slide 4 is the reverse repo facility.
Oops, sorry.
Yeah, sorry, I skipped ahead of you.
No worries.
It's effectively zero. Look at the right side of the screen there, down from $2.5 trillion in 2022. So these slides are showing why we have a liquidity problem in the markets. Positive real Fed funds rate, causing bond market volatility spike. Reserve balances got very low. Reverse repo facility, which is fallow excess reserves being parked at the Fed that went into the bond market. Well, they're gone now. And that's why we're doing 40 billion in QE. Slide 5.
Sorry, before we move real quick, let me just make sure folks really understand this. So think of the reverse repo facility as a big sponge. And when you put a sponge, say when you submerge it in water and you pull it out, the sponge is saturated with water, right? And that's pretty much where we were when this reverse repo facility was at its highs here. The sponge had a ton of water in it. So as you squeeze the sponge, it's pushing water or liquidity out of the sponge into the world, right? And so it's this nice tailwind for the markets. It's this excess liquidity. It keeps everything running, lubricated, creates extra liquidity that can go into asset prices and push them higher, and everybody's happy, right? So now we've got to the point where the sponge has been squeezed dry, right? And so we're not getting that extra liquidity anymore. And so that was probably what your model was picking up on, Michael. So you can have a problem with a dry sponge, but to refill, like if we wanted to refill the repo facility, well, that's a sponge that's sucking water out of the system. And that would create even bigger problems. So the Fed is sitting in a challenge here where it's like, well, I got this dry sponge. It's not providing the tailwind anymore, but I'm afraid to start refilling it because it'll shift those tailwinds the system used to have into headwinds. So I just wanted to sort of help folks understand where we are specifically with the repo facility. Now he can help out by providing liquidity other ways, which is part of what he just announced.
Yeah, I mean, they could flood the banking system with reserves enough to fill a reverse repo facility, but it would have to be more than $40 billion a month. It would have to be like 100 billion a month, some number like that.
Yeah.
Banks would have reserves, they could hold on to reserves, and they would park reserves at the reverse repo facility, and it wouldn't make a difference to them. But that's not, we don't have that yet. As a matter of fact, that reminds us of something else I want to make sure I mention before we run out of time, is the first Fed meeting of the new replacement, what I like to call affectionately as an obsequious sycophant of the administration, who I mostly support and voted for, just a caveat. Kevin Hassett is the odds-on winner there. He doesn't get a vote until June 17th. So not only you have to ask yourself problems that could exert themselves as far as exacerbating the liquidity crisis that was happening starting on November 6th. You could say, well, is one rate cut between now and one more? That's what that's what the markets are projecting. One, maybe two at the most, between now and June 17th. Enough? Is it going to be enough to provide the liquidity for the bond market? Is $40 billion in QE going to be enough? I mean, probably is. I don't know for sure. My model will watch it assiduously. But the question is, do you want to just ignore that fact? And I wouldn't. I would pay very close attention to it. So now slide 5, Adam, is the Japanese benchmark yield, benchmark treasury. So the benchmark yield is at an 18-year high. And don't forget, the yield range between 0 or below between 2016 and 2021. That was under Shinzo Abe and his interest rate repression regime, where he capped 10-year note at 0. But when you have a quadrillion, I think it's like 1 point. Yeah, here I wrote it down here. So the new minister, and I won't pretend I can pronounce her name correctly, Sine Takachi, she went to add $21.3 trillion yen in a stimulus program. And that added to the $1.3 trillion yen in debt, which is 240% of GDP. So this rise in yields, which is
Wait,
dragging
you said trillion. Is
trillion
it
yen,
a trillion or is it quadrillion?
it's 1,300 trillion yen. So it's 1.3 quadrillion yen. Thank you if
Yeah.
you corrected me. I don't know if I don't know if I misspoke, but it's 1,300 trillion yen. So, that's a lot of yen, right? So, so they have abandoned their interest rate repression, where the BOJ was just buying every JGB auction,
Yep.
the central bank. They abandoned that, and look where yields are going. They're going up, up, up and away. Um, and the last slide that we have
Yeah.
is the
So
yen.
sorry, but before we get there, so hey, this endangers the carry trade, which you talked about earlier. But just to underscore, that's been just sort of a huge component of how markets have worked over the past couple of decades.
Yep.
So if that goes away, and TBD whether it will or it won't, but if it does, I mean, the system it's like losing a limb. Like the system's going to have to learn how to operate differently. And it's going to be curious to see how it does that. Also, Michael, I had heard it said, years ago that Japan was so over indebted and, having a quadrillion in debt, it catches the attention. But it was so over indebted, especially on a debt to GDP basis, I think in most of any country, that I'd heard it said once that I think back when yeah, yields were, I don't know, back in 2022, they're what, like 0.5% or something like that in the 10-year. I had heard that if the 10-year treasury in Japan rose to like 1 or God forbid 2%, that it would just blow up the economy there. It would just blow up the
Mhm.
country. Is that a real danger here?
Yes. The short answer is yes.
Okay.
Absolutely. Yeah, when you have 1,300 trillion yen in debt, 240% debt to GDP, your economy stops functioning as rates rise. And it's not only the actual level, which is almost 2% now, it's the rate of change. This was zero or below in 2021. So it's the rate of change that I'm really watching here. And
Right. But
I
like
think I
throwing a
think
person into Arctic waters, you just, it's a shock to the system.
yes, yes. And it's dragging yields higher across the globe. So um, we'll see what happens there. But
So,
that's
so is
why,
it safe to say, let me just ask you this, if yields don't come down materially from here, what do you expect? I mean, do you expect Japan to just grind to a halt and enter
yes,
into a deflation?
I expect the BOJ to go back into interest rate repression, where they just put a cap on the yield on the 10-year. I that's what
Okay.
that's what I expect will happen. I don't know if it's 2% or 3%. I don't know the level, but I expect that to happen.
Okay. All right.
Uh,
Sorry to interject, but those were important questions.
yeah, always. So the yen carry trade is eroding. The estimates for the size of this carry trade, which is, it's important enough for me to put it in my model. It doesn't just get there by osmosis. So I back tested everything. And the reason why it's there is because the yen carry trade, as you said very eloquently, is that it's a major source of global liquidity. And when that dries up, there's a huge problem in funding markets. So the size is between $4 and $20 trillion, the entire size of the yen carry trade. And the blue line on this chart represents the US 10-year and the JGB 10-year. Now the spread between the two was 400 basis points in 2023, and now it's about 200 basis points. So you're getting to the point now where when you factor in currency protection, currency hedging, that you can no longer make a profit by borrowing in yen and buying up the U.S. assets.
Hmm.
So it's those six reasons that I mentioned that caused me to get more cautious. Now, in all honesty, yesterday I went a bit longer on some healthcare stocks just to bring the portfolio up to 20% net long. But given where we are at a total market cap of equities to GDP at 200 and almost 230%, which is, into the thermosphere of valuations, you have to be very careful. And if you're out there 100% long AI stocks in an S&P 500, equity only portfolio, you could be in a world of hurt in 2026. I want to make sure we get to the three reasons why I think there could be trouble in 2026. But I just want to wrap up this PowerPoint so people understand how my model works, what got me, more bearish on November 6th, what saved us from losing money then, and what we're looking at going forward to make sure we make the right decision. Well, if credit spreads start to come in again and stay quiescent, and financial conditions continue or start to ease again, while we'll be going long, because a lot of these slides will start to be to mollify, or the opposite, when we will finally go net short and start riding the four horsemen of the economic apocalypse, which is a tremendous opportunity to not only protect your money, but to profit from the demise of this massive bubble that we've built in equities. And when I say we, I mean mostly I'm pointing fingers to the Federal Reserve, the ridiculous malfeasance that's going on there.
True, although Congress is similarly complicit with their wanton spending ways that the Federal Reserve has been helping enable as well. Okay, so lots of blame to go around, but I agree. Fed central character to point the finger at. Okay, so let's talk about the specific concerns and risks and how you plan to sort of surf 2026. But real quick, you had all these concerns last week. Post the FOMC announcement of the 40 billion per month, do you feel like that is pushing off the reckoning a little bit now? Is that buying the Fed extra time here? Is it pushing some of your concerns a little bit further off in the timeline or not?
According to my model, it has. It bought some time for sure. Because like I said, its financial conditions stopped. They were easing. They stopped easing. They started to tighten, and then they're getting easy again. And if you look at credit spreads, they started to narrow again. So that just tells me, based on all the components of my model, that it's time to get a little less cautious. And which is exactly what I did. This is why yesterday I went and bought some more healthcare and added 5% more net long to the portfolio.
Right. You went from 15% net long to 20% net long.
20%, correct.
Okay, yeah. And sorry, I should have asked this earlier. What sector does your model, is it in right now?
We're in sector 3 right now, bouncing around. We went to 4, then we went quickly to 2, and now we're into 3. So things are moving.
And I'm sorry, I know we do this every time, but can you just very quickly name what every sector is so folks know?
So sector 1 would be rapid disinflation or deflation and a recession. Sector 2 is just a mild disinflation. Sector 3 is stasis. Sector 4 is reflation, and sector 5 is stagflation or intractable inflation. And in each sector, back tested rigorously, you'll see what stocks, what bonds, what currencies, what commodities you should own, and it varies greatly. But I want to what happened in the past few weeks should hammer home how over financialized and how fragile our entire economy is. I mean, just having the idea that we wouldn't get a rate cut in December because reserves were getting a little scarce. And I pull up a chart look at that chart on reserves. Reserves were non-existent. I mean, they're very, very minimal for many, many, many decades. And then they spiked up to like 3 trillion in reserves. And now they're down. But they're not down relative to where they were a decade ago. They're just down to where they were in 2020. But just the rate of change caused the whole system to freeze up. And in those 6 days, we saw the S&P 500 drop 5%, QQQ is down 6%, Bitcoin down 19.5% in just 6 trading days. And the only thing that ameliorated that process was the fact that the Federal Reserve had to step in and launch QE and cut rates. That's how fragile the system is. And it's very sad that it's become so dependent on never-ending continuous interest rate repression and debt monetization and money printing from our Federal Reserve.
Okay. So, Michael, some people would say, yeah, I get all that. So maybe it's bad, right? Maybe you think it's bad that the system's dependent on this, all this stuff. But if prices keep going up and I own assets, why should I care?
Well, you should care because there'll be a time. Here's a succinct answer. I'll try to be succinct as possible. There will be a time when that very process just leads to exacerbating the inflationary process, which leads to a spike, intractable spike in long-term interest rates. And if that's the case, there's nothing they can do. I mean, you can't stop a problem where the bond market's blowing up because of inflation by creating more inflation.
Mm-hmm.
That doesn't solve the problem. And you can't fix an insolvent nation by launching more rounds of helicopter money. So when the long end of the bond market finally blows up, and it will, then you see these asset prices will crash concurrently. Credit, real estate, and equities. That's why you should care. And people say, well, didn't we have a problem in 2008? We had a crisis in 2008. We had a credit crisis. We had a housing crisis. We had a stock market crash. Why can't they just do the same thing again? Well, first of all, you have to think about what's different. First of all, the total market cap of equities as a percentage of GDP was 107%. Now it's close to 230. But that didn't stop the stock. When it was 107% of GDP, the market still crashed by 50%.
Mm-hmm.
So imagine how much it's going to crash. And they started manipulating interest rates lower in the summer of 2007. The market didn't stop going down until March of 2009. So just because the cavalry is riding to the rescue doesn't mean they've reliquefied the system. That didn't happen until rates went from 5.25 to 0, and Bernanke was buying 80, 90, $100 billion of bonds every month.
Right.
Mortgage-backed securities, to be specific. So there's a salient elevated risk that the next time they come to the rescue, because of the insolvency that we now have as a nation, insolvency meaning we have $2 trillion deficits, $1 trillion in interest payments, total debt to GDP is now 125%. It was like something like 80% back in 2007, much lower. And we also have an intractable problem with it, not intractable, but I don't use hyperbole. We have a problem with inflation getting back to target. Whereas in 2008, the problem was, we were wringing our hands. We just can't get inflation to 2%.
Yeah, quote unquote, too little inflation.
Yeah. So for those three reasons, things could be very different next time.
Okay, great. And I just condense that even more to say, the more distorted the system gets by the policies that are used to stimulate, you increase the risk of a dramatic downward repricing when things go off the rails, right, which you just described. The other thing I would say along with that too is because those policies in general are inflationary, you are damaging on an ongoing basis the purchasing power of the economy. So you kind of end up with the worst of both worlds, where you're down the road, your dollars buy less, and then you have a lot less dollars because you've had a big repricing in the asset markets, right? So you kind of get the worst of both worlds. And then I guess the third thing is none of that does anything good constructively for the nation, right? You end up with a damaged nation, a damaged economy, a damaged populace. There's just no good about it in the long run.
Adam perfectly said, but I'd add to that, we already have the bottom 80% of the economy, the consumers have been, severely injured. It's only the top quintile that's really working.
Yeah. Let me ask you this, sorry to interrupt, but so I talk about this all the time, and people have heard me talk about not just the K-shaped economy, but I think it's in danger of metastasizing into a lowercase I-shaped economy, right? Yeah. Just put on your bullish hat for a second, Michael. What could get us out of this? What could get the bottom 80%? Let's look with the 5-10 years down the road. What could happen between now and then where we could be talking about how, hey, it's no longer a K-shaped economy and everybody who's, that bottom 80% is feeling a lot better now?
I guess you'd have to.
I ask just because I have trouble coming up with that answer.
I guess it would have to be an artificial intelligence productivity miracle where the massive increase in supply without damaging labor too much.
But how do you?
Well, you asked me to put on a bullish hat, which I don't really, I don't own many of them, So,
well, and I understand why, but let me just clarify. I don't think you're a bear. You're not a perma bear, right? You're just a practical guy. You're a realist.
Yeah. As anybody can pull up the tapes from our interviews, I turned very bullish in late April after being bearish at the start of the year and rode that, wrote a very nice return for me and my clients this year. So, um, but now I'm a little more cautious, and the reasons why I can go through quickly if you want me to go through the three salient risks for 2026 if we still have time.
Please do it unless I interrupted you and you actually had some magical solution. I shouldn't say magical, some convincing solution why we should feel optimistic about the bottom 80%.
Well, I believe in mean reversion. Nature hates vacuums. I can't come up with one example in history where you saw the numerator of say the total market cap of equities or home prices stay where it is and had GDP and incomes catch up. The bubbles don't burst that way. They burst violently where the numerator and denominator both go down together. And then until they have some kind of mean reversion and normalization. So that listen, I'm open to the idea. I hope and pray that it happens. I just have never seen it before, and no one else has either.
Yeah.
But if that happens,
I guess my answer to this question, as I think about it, is I can see the wealth gap narrowing over the next 5 years, but it's not because the bottom is getting pulled up. It's because the top is getting pulled down. Yeah.
right. That's egalitarian socialism. So everybody's equal. We no longer have a lower case I economy, but everybody's
Right. Well, and that could be because of political means where there's, confiscatory policies or whatever. But also, I'm just thinking more about your part, which is, hey, we've got I mean, we haven't even talked about the CAPE ratio and the Buffett indicator and all that stuff, but we're at all-time high, valuations. But to your point, the system could just, start to really break, and then we get that big correction, that big reckoning in asset prices, and that would bring the top 10%, down.
Yeah. So when I say total market cap of equities to GDP, that's the Buffett indicator, and if the Buffett indicator says that the average return for the next 10 years will be -1%. And I don't think it's going to be -1. It's going to look more like -50, -60, and then up 100, something like
Right.
that, close to that. So you want to be, that's why I make a very strong argument for active management. Active management with a robust, smart model that works, that you can get out of harm's way when this stuff really starts to, I call it the great reconciliation of asset prices, which is guaranteed to occur. It's just getting the timing right.
Yeah.
That's what we try to do here.
So I find I'm really starting a lot in the past couple of weeks, been making the exact same case. So, and of course, that's exactly what you do. So we're getting right into your wheelhouse here. Before we talk a little bit more about that, though, I think I interrupted you and you were going to talk about your three big outlooks for 2026. I want to make sure we don't miss that.
Okay. So the three dangers of 2026 are number one is, and this is, I guess this is the in ascending probabilities. So number one is, and this is the lowest probability, that we only have one more rate cut between now and June 17th, and the $40 billion in QE isn't enough. And even if that is the case, and we have a liquidity crisis and a credit market crisis, and a bond market frees up, money markets freeze up, I think Powell will react, if he's still there, will react almost immediately and just flood the system with money. Of course, the dollar will get destroyed, and we can get into the allocation where I think at the end of this conversation, where you should be allocated with your assets if that's the case. A little slightly higher probability is that the AI credit bubble bursts. Hundreds of billions of dollars are being borrowed now, not cash flow any longer. It's borrowed funds being thrown at this. And this, to me, is even, I'm not disparaging AI. This just smacks of the overinvestment that occurred in 2000. We're buying switches and routers and fiber optic cables, just not because the internet was a false flag of a technology, and it wasn't that it wasn't going to be massively in accretive to productivity. It's because Wall Street just went crazy like they always do.
Right. And with every technical transformation like this, we overbuild too quickly, and then it takes a while for the economy to fill out the full potential.
We buy too many. We buy too many of these chips and build too many of these data centers, and the economy needs to reset. But the highest probability is the fiscal and monetary madness. So we're starting at $2 trillion. That's the baseline deficit for fiscal 26. Then you add to it $1,000 for every child born that's being floated out there.
Hmm.
$2,000 checks to everybody who makes under $100,000 a year. That's being floated out there. We naturally, because the one big beautiful bill, we're going to have big tax refunds going out in April. That's the fiscal impulse, and then of course, you have the monetary impulse. You have Kevin Hassett who said, "Hey, listen, there's plenty of room to cut interest rates," and even Austin Goolsbee, who actually dissented and said, "You know what? I don't think we should cut rates." Even he came out and said, "You know what? I think we can cut rates a whole heck of a lot next year. It's just not the right time." So I mean, you can imagine if we have 3%, 3.5% GDP growth and real GDP growth, and then you have 3% plus inflation, that's 6.5% on a nominal 10-year yield. That's why I shorted the 10-year note yield when it was 4%. And so far, I've been only marginally correct. I think I'm going to be wildly correct. If we don't have a recession, if we don't have a credit crisis, we are going to have a blow up in the bond market just because we have so much fiscal and monetary madness going to happen in 2026. And I think if those bond yields go north of 6%, I think that completely submarines the housing market and completely blows up the credit bubble, obviously, and also the equity bubble. I just want to add one anecdote. I have a couple of houses here in Florida. One house that I have in Naples, Florida, is already down 20% from where I bought it in 2022.
Well,
I'm no
okay.
I'm no Nick Gurley, I'm just I'm just telling you from what I could see. And guess what? People say, well, it's only Florida and it's only the Sun Belt. Well, that's where all the people move to, and that's where all the bank loans sit in. All those bank loans that were made from 2020 to 2023, they were all made to the people moving out of the Northeast and the Midwest and coming down to the Sun Belt and buying asset prices, homes that were way overvalued and unsustainably so. So there's going to be a lot of bank distress as well.
A lot of bank stress. Okay. And I should note too that despite uh, the announcement of 40 billion a month for getting back to ample reserves and all that stuff, the 10-year bond is still at 4.2.
Yeah.
So it hasn't come down at all.
Is it 4.2? I thought it was more like 4.12, 4.12.
I'm looking at it right now, and it's at 4.194.
4.19, so almost 4.2.
Yeah, so almost 4.2.
Not 4.02. Okay. Gotcha. You're correct. Sorry. So that's the wrong direction from where, I mean, that's the right direction for me because I shorted, but 4.2 is nowhere near where it should be. In nominal GDP, I mean, Atlanta Fed has us at 3.5%. And that's before we have all this fiscal and monetary madness kick in. So there's a very cogent argument to make that the bond vigilantes wake up. That's the highest probability of why I think this thing can crash, because you'd have a credit market train wreck and chaos in 26.
Yeah, and all I'm saying, giving validation to your point here, is that despite the 3 rate cuts that we've already had, and then now the cessation of QT, and now the announcement of QE or
QA.
reliquification, whatever you want to call it,
Yeah.
the 10 years not coming down at all.
No, no. Why would it? Why would it come down when not only my nominal GDP argument, if you don't like that, when we're pursuing more inflation, when we haven't gotten back anywhere near to 2%, we're closer to 3. Why would the long end of the bond market do anything else? Doesn't make any sense.
Right. Well, it's making sense to you, and you've made your your bet on it. And yeah, if to your point, we get even more, what are you saying, monetary mayhem in 2026 that the vigilantes don't like, and they take it high enough to break the housing market and break the other parts, and the banking system's under stress from like the loans you were talking about. Things could go caterwonk pretty quickly. All right. Well, look, we only got a couple of minutes left, Michael. So 2 really key questions. I'm going to ask one I usually ask at the end, but we'll put it up here at the front before I ask the second question. For people that have A, enjoyed this conversation, B, enjoyed all my past conversations with you, feel that you've got a really good read on things and you've got a good model that's helped guiding you here, where should they go to learn more about you and your work, and potentially even if they want to become a client of yours?
Well, thank you, Adam. Pentoport.com is the website. I have a midweek reality check podcast for $50 a year. It gives you the interpretation, my interpretation of the salient economic data. And if you are a US citizen and you're qualified for a long, short, actively managed strategy, and you have $100,000 a US citizen, I will directly manage your money in the inflation, deflation, and economic cycle portfolio.
All right, great. And Michael, when I edit this as usual, I'll put up the link to Pentoport there on the screen so folks know where to go. Folks, the link will be in the description below this video too. All right, so in wrapping up here, you talked about, hey, if things start getting, rockier this year, your model obviously will shift into different sectors and tell people how to invest. So if the year goes the way that you think it could, talk about how your allocation would change from sector 3 stasis moving through sector 2 into sector 1.
Well, it depends on what's the catalyst for the chaos,
Okay.
what's happening. So if it's um, a blow up in the liquidity because one more rate cut didn't quite do it, and the $40 billion a month didn't quite do it, we'd be moving towards sector 1, which is rapid disinflation, deflation, and recession. So that's where the four horsemen of the apocalypse come in. So you have cash, you've got short-term treasuries, you've got the US dollar, which you want to own, and you'd be shorting the stock market. On the other hand, if it blows up because of runaway inflation, I would increase my short in the bond market, and I would buy base metals. I actually would increase my energy holdings as well. So right now I'm in and out of silver. I've owned gold and platinum for a long time, and I own energy, and I would be increasing all those positions as I short the bond market, the long end of the bond market. That's where you'd see the work, because the stock market can go down along with bonds, just like it did in 2022. So asset prices go to a correlation of 1, and everything gets flushed down the toilet.
All right. Michael, I hate to wrap it up here more quickly than normal. I love to go long with you normally. We'll just have to rectify that early in Q1. We'll have you back on in January to give us a sense of kind of a real-time audible about where things are. And just in wrapping up real quickly, 2 bits of housekeeping. One, if you'd like to talk to Michael, obviously talk to Michael. Go to pentoport.com. If you've got questions about how to manage your portfolio for next year, position for a lot of the things that Michael and I have talked about. If you don't have a good professional financial advisor who's advising you through that, feel free to talk to one of the ones that Thoughtful Money endorses. To do that, just fill out the very short form at thoughtfulmoney.com. These are the financial advisors you see with me on this channel week in and week out. These consultations are totally free. And there's no obligations involved. It's just a free service they offer to be as helpful as possible. Also want to remind folks too, if you haven't seen it yet, Thoughtful Money is a precious metals endorsed provider. It's Andy Sheckman's company, Miles Franklin, is offering exclusive for Thoughtful Money followers while supplies last. They're offering junk silver for $1 under spot price. And as you've seen this week, silver has just been on an absolute breakout tear. So if you hadn't known about that offer and it interests you, you can go reach out to Andy's firm about it by filling out the very short form at thoughtfulmoney.com/buygold. It is always such a great pleasure to talk to you, my friend. Thanks so much for coming on.
Always a pleasure, Adam.
And everybody else, thanks so much for watching.
I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, and have another nice run, probably to 4,000 in the last 4 months of the year. Silver, I have a 75 target that I've had for a long time. I think gold can get to 20,000 by the early 2030s. And I say early 2030s. That does not mean 2030. It means could be 2032 or 3. I don't know.
Yeah.
But 20,000 for gold and 500 for silver.
Gold recently hit a record high of around $3,526 per ounce, buoyed by a weaker US dollar, inflation fears, and declining confidence in treasuries. Analysts from Goldman Sachs and Morgan expect gold to reach $4,000 by mid-2026. However, silver is the standout performer of 2025, up around 40 to 42% year-to-date. Optimism is growing that it may finally break a multi-year underperformance trend relative to gold. For silver, the near-term target is $75, while the long-term targets of $20,000 for gold and $500 for silver remain highly speculative. Current trends and expert forecasts suggest gold may approach $4,000 in the near future, and silver could begin to make significant upward moves. The speaker, David Hunter, a famous personality in precious metals, believes Wall Street has been too skeptical of this rally, while retail investors have fared better. Strong corporate earnings, driven partly by AI, and an underlying weak economy point to lower interest rates ahead. He expects the 10-year yield could fall to 3% by year-end and eventually to 0% as his global recession or global bust unfolds. Contrary to the mainstream view, he sees both short and long-term rates moving down, supporting bonds and even corporate credit in the near term. Hunter views this as the final stage of a 43-year secular bull market that began in 1982, with the Dow then at 780 and potentially reaching 60,000 soon. Falling rates, strong earnings, and a weaker dollar could fuel a parabolic move higher as institutional investors finally capitulate and turn fully bullish. In Hunter's view, this capitulation will provide the momentum for a steep final run in the equities. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street. But ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great. And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end is going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay. That we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a 42-year, and it stretched out. But it started in August of 1982. And the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780, 780. And I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se. I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. And people say, "Oh, you've already pushed it out again." No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far, that fast, it's a parabolic that I think comes at the end of such a long cycle.
David Hunter recalls his success in 1982 and draws a parallel to today, noting that when the Fed eases, bonds, equities, and metals typically all rise. Hunter expects a similar setup in the coming months but warns this cycle is unusual since it didn't start from a bear market trough. While many have fought the rally, Hunter believes the eventual top will come when everyone is fully bullish, at which point he'll turn contrarian, and quadrillions and derivatives turn a normal downturn into a severe global bust. On commodities, Hunter has been bearish on oil since 2022 and sees it possibly falling to $30 during the bust but then soaring to $500 by the early 2030s. Hunter argues massive money printing, $20 trillion in the US and up to $50 trillion globally, will drive huge demand for commodities to build new infrastructure, while supply growth remains constrained for years. This mismatch, Hunter says, ensures explosive price increases once demand outstrips limited supply.
I guess I cut my teeth in this. Like I said, my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle, right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough,
Sure.
We didn't go through a bear market. So that's what's unusual. And I think that's where people are going to probably get it wrong is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run. And I'll be at that point contrary and saying, no, this is the top, we're close to the top. And I think we will actually see CPI negative, PPI negative, even PCE negative. And it comes, my reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because, we're so far beyond even 2008-9 in terms of leverage on the system, both debt, as I keep quoting, 330 trillion in global debt. And I realize a lot of it's sovereign, but 330 trillion in global debt and quadrillions in notional value of derivatives. Never been here before. Never. And derivatives are leverage on markets. Debt is leverage on the system. Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. So that's how I get to a global bust. I de-bear on oil since 2022, and correctly so. I turned bearish on oil before. We had the the spike up during the Russian invasion of Ukraine, but I stayed with it at 130 and said we're going back to 85. And then once we broke 100, I said we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went to negative.
Who knew?
But I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle. Copper could be 20 or more. From, it could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand, and we've rationalized down supply. The mining and all that, and search for oil, etc. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years, whereas the having to build new supply can take 10 or 20 years. So you're going to have a case where you're going to have supply far exceeding demand, and the only thing that can give is price.
David Hunter envisions an extraordinary but volatile path ahead. First, a deflationary global bust, then an unprecedented boom fueled by massive money printing, collapsing interest rates, and surging demand for commodities. While his bold forecasts for gold, silver, equities, and energy markets remain controversial, they highlight the risks of extreme leverage and the potential for historic shifts in global markets. Do you think Hunter's prediction of a global bust, followed by explosive commodity inflation, is realistic or overly extreme? If gold and silver do reach his long-term targets, how might this reshape global financial markets and currencies? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
Clearly in Asia, particularly in China, they view it as money, and of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. People who are going to talk about, the Hunt brothers and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple-digit price of silver is a legitimate target.
In Asia, especially China, gold is still seen as real money, and that perspective is spreading among BRICS nations as they move away from reliance on the US dollar, a trend that strongly supports higher gold prices. China's central bank continues buying gold. In August 2025, it purchased about 2 tons. BRICS nations are developing alternatives to dollar-based financial infrastructure, including digital payment systems and local currency trade. Gold is increasingly seen as a neutral reserve asset among these countries. Given these shifts, a long-term target of $4,000 for gold looks reasonable. Silver also has enormous potential. Adjusted for inflation, its 1980 peak near $50 would be closer to $200 today, making triple-digit silver a realistic and justified goal. Peter Grandich, a veteran market analyst and financial commentator, recalls that back in the 1970s and early 80s, few believed the Dow could ever reach 3,600, let alone 36,000, but history proved otherwise. just as today many doubt gold's ability to climb much higher. The reality is that fundamentals for gold have never been stronger. De-dollarization is accelerating across Asia and the global south, with central banks and retail investors boosting gold purchases and trade in local currencies rising. BRICS nations are building alternatives to dollar-based systems, and gold is increasingly viewed as a neutral reserve asset. China continues steady gold accumulation, though its reserves remain low compared to its economic size, leaving room for much more buying. Analysts expect this sustained demand to lift gold's floor higher, with BRICS discussions of gold-linked trade further supporting long-term price growth. BRICS nations are exploring dollar-free trade, with gold discussed as a potential benchmark or backing asset, though no unified gold-backed currency exists yet. Rising central bank demand, especially in Asia, is lifting gold's price floor, while silver also shows huge upside, with inflation-adjusted targets pointing to triple digits. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article. We value your opinions.
For 13 years, the Dow only traded between 700 and 1,000. In fact, the very famous Business Week front page said equities are dead. Wall Street was extremely bearish. And an unknown young man came out of Gainesville, Georgia, named Robert Prechter Jr. with a philosophy and a technical analysis no one really knew of, Elliott wave theory, and said the Dow's going to 3,600. And they just prosecuted him to call him every name in the book. And then when the market took off, he became popular, and then he made a call about the crash in 87 along with me. And the perception was, how could it possibly go to 3,600, let alone a few decades later, 36,000 and more? So that same feeling's in gold right now. People, especially people that have been bullish and profiting from it, this 36, this is way out of line. Yeah, it's great. It give you all the reason, but how could it go a lot higher? It's not possible. You have to take that same philosophy. There's no reason it can't. In fact, I would argue it's not cheap anymore. Someone that was buying it at 1,300, seeing a tripling. But the fundamental argument for gold has never been better. We had at one time suppression by central banks who were offloading it. Now they're the biggest buyers. We had clearly not any society thinking it was money. Clearly in Asia, particularly in China, they view it as money. And of course the BRICS, and that's one of my biggest bullish factors for gold, is I saw the de-dollarization and countries moving away from the United States economically and from their currency as bullish for gold. So I think the more important way to answer your question is not talk about some of the general stuff or inflation or even against the stock market, is to admire how it's performed in an environment wasn't as conducive as it is now. So that would argue that I still think it has to go a lot higher over time, but I think a reasonable target of 4,000. And remember, when you're in all-time highs, other than a psychological number, there's no real resistance. So, pick 4,000. Yeah, that'll be a round number and so forth. And, Wall Street has treated gold like kryptonite. I think 0.5% of portfolios are assumed to have some exposure to gold. Can you imagine if people just went to 1 or 2%? It's still a very, very viable market for the long term. Well, I think it's going to play a significant role in the BRICS. They have not acquired all of this gold as a trade or a personal investment. They certainly can't flip it to someone that's going to pay even more so they profit from it. I think it's been accumulated. It's still probably 12 to 24 months away before they officially come out and say, okay, this is how we're going to trade among ourselves. And part of that is going to be gold. I don't think there's a worldwide situation coming anytime soon, because I think things have to get a lot worse before people realize how messed up we been with fiat currencies. I do still think that one of the ways that they're only going to be able to sell treasury bonds, especially long dated ones, a year from now, because I'm a big believer that short rates can fall, but long rates are only going to go higher. I think that's going to find a way that the Trump administration could reprice its gold that it owns to whatever the current price is, and also introduce longer term 40 or 50-year bonds with some sort of gold backing in order to get people to buy it. I think that's going to be how difficult it's going to come for the United States to fund itself, while other world bond markets, as we speak, are imploding as well. 180, and it was profitable to treat it as the second-class citizen to gold. But earlier this year, when it dipped under 30, when I looked at the fundamental argument, it was never stronger in the 41 years I've been involved. So I became a silver bug. And I also said it probably would lead gold for quite some time to come. And I think that's happening here. I think you make an excellent observation. People who are going to talk about, the Hunt brothers, and once went to 50, well, to get back to that, you're right. It's almost going to have to trade at 200 for inflation. So what I have said, and it probably throws me into the silver bug camps completely, is that triple digit price of silver is a legitimate target. First of all, it's not that much more than a double from here. It sounds like a lot because for a lot of years it was single digits, low price. But I think it has every reason to continue to rise with gold. And the competition for it, the stock market, I have to throw this in. I made a big change a couple of weeks ago. I was not in the stock market crash camp. My January forecast for our clients was the stock market was going to be either side of unchanged. I told people to avoid U.S. equities, get into world funds. I love the Chinese market. But a couple of weeks ago, stuff just screamed that we were very vulnerable to a hard fall or even a crash. And that has been competition to gold and silver and also cryptocurrencies. And so a lessening of the bull move or an actual decline, as long as it's not a total crash, could only aim the gold and silver. You know how I know that, Jesse? I left the metals and mining industry as a main place of business for myself in 2013. I dipped myself back in 5 years ago when I got very aggressive in gold and mining stocks and all. But I'm hearing from people in the last few weeks that I haven't heard from 10 or 20 years. And saying, hey, I was looking up metals and I saw your name. I thought you left the business. And then, of course, the follow-up question is all the same. So what do you like? And I think we're just at that stage now where, other than that little audience that always confined ourselves to, we used to call ourselves the hard asset crowd. I don't think we say that anymore. It's being broadened out to generalists. And I think that's going to bode to help the metal prices higher.
Peter mentions that the mainstream U.S. financial media won't highlight gold and silver because of their ties to Wall Street. But once public demand grows, that will change. Major gold producers are already generating huge cash flow and could see much more interest as generalist investors notice their outperformance. The largest gold miners reported record free cash flows, revenues, and profits in Q2 2025. Margins are very strong. However, production has fallen for some majors. Juniors are expected to outperform seniors in this cycle due to high leverage and exposure in exploration and resource discovery. Established miners are expected to continue reporting strong cash flows, using capital for dividends, buybacks, and to shore up balance sheets. Despite strong gold price performance, analysts, including Peter, believe gold stocks are lagging and undervalued relative to gold itself. Analysts are watching for better leverage to gold, and many see additional upside as investor attention and valuations catch up. Let's dive into the interview.
Well, much of the mainstream financial media in the U.S. is tied to the hips of the financial service community. They're not going to write things go against it. They're advertisers, So I never expect them to write glowing stories about that, because gold and silver have been treated like kryptonite since I've been in the business by the financial service industry. And I don't expect that to change until the public overrides that demand and says, hey, listen, I'm listening, or I got this neighbor and they're killing it, and blah, yada, 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 yada. And so that's when I think the public will come to it. The mining stocks, even the exploration, and they're two different species, and I'll address them both. The mining stocks, as I said earlier, when I originally sold some of my physical gold in the beginning of the year at 3,500 to buy the major gold producers, which greatly outperformed the performance of the physical gold, they have many quarters ahead of just unbelievable, legitimate printing money through free cash flow. And what will happen for them and what will keep that sustained for them is, as we peter out in the stock market here, and we're seeing a lot of companies now not meeting the low-end earnings estimates, so they can always say they beat them. These generalist money managers are going to hear about these mining companies. Look at Newmont Mining. Maybe today, as you and I record, depending on if Palantir gets hit enough and Newmont is rising, it's going to be the best performing stock in the S&P 500. Right now, it's number 2. And so that means it's outperforming 498 other general equity stocks. And yet, I would tell you that if we looked at people's portfolio, not half or 1% have Newmont Mining in it. So there's still so much upside demand for mining shares, and they should do well. But where I went to, and it's the most riskiest and speculative end of it, and remember, Wall Street created the word speculating, so don't really call it what it really is, and that's gambling, where you have to be mentally and financially prepared to lose part of all your capital. But the juniors is really where we're going to see a really bang for the buck. We're already seeing that in some incidents. And the reason is the world has not only shrunk to where companies can go and without too much risk and try to find the metals that are so critically needed now, everybody realizes, but the amount of money that has not gone into that industry to find these things. And remember, even if you hit it tomorrow, that you just went to a rock and drilled and it doesn't work that way, it takes several years of exploration and all. It's probably anywhere minimum, depending where in the world, 10 to 15 years before it comes out and pours the first metal and all. So when that recognition is realized by everybody and everybody realizes how we're scrambling, a gentleman made a good point to me the other day, and it was Sam Lee, it's actually the largest stock that I own, North Island Copper and Gold. And he was just on a trade mission for Canada to South Korea and Japan. And he made a very good point is, even though they're world renowned for producing so much of the stuff we need, technology stuff, appliances and all of that, their entire base of metals that they need is from outside their country. They don't have any real own supply of their own. So here we have the world is scrambling for critical minerals and all. There's not been a lot of money put in them. I think that's going to make exploration companies become darlings for a period of time. And the majors, their currency is so strong now because of their stock, they're not going to try organic growth. They're just going to go out and buy because we're still seeing good deposits selling for as little as $20 an ounce with gold at 3,600 and going higher. So to answer your question, I'm sorry for being long-winded, but I just think the mining shares and the exploration stocks, their day in the sun to where everybody's seeing it hasn't even arrived yet.
Metals and miners are poised for a solid next run higher, with fundamentals stronger than ever. Will the formalization of a gold-linked trade system by BRICS eventually hasten the move away from the US dollar? Is it possible that cheap mining stocks may eventually overtake gold's performance and produce disproportionate returns in the upcoming cycle? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
So you're seeing retail catching the wave, which is driven by governments buying gold, right? So they have to get out of the way of the price. The price is running. Now silver's running. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
China's saying, we're just growing, we get bigger and more powerful. We've got 4 times more people than you, and give us 10 years, we'll have as much money, so we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute, no, we're in charge here, and stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that.
Retail investors are now riding the momentum in silver, fueled by governments accumulating gold and pushing prices higher. With the market moving fast, the real question is where it's headed next. On the global stage, the US is signaling aggression as it seeks to maintain dominance, while China, with its massive population and rapid economic growth, is positioning itself to rival America within the next decade. The US sees this rise as a threat and is determined to halt China's advance, setting the stage for escalating tensions that are further driving demand for precious metals. Clem Chambers is a well-known financial commentator, author, and entrepreneur. He highlights that gold is surging because governments view it as the currency of war, a hard asset essential for defense and global power, beyond the reach of paper money or manipulation. With the US and China in open rivalry, central banks, especially China's, are buying heavily, driving prices higher. Silver, on the other hand, has always been everyday money. So as gold becomes too expensive, retail investors are piling into silver as the affordable alternative. Together, this creates a chain reaction where governments fuel gold, retail fuels silver, and institutions can't stop the momentum. For additional information, view the video. Please subscribe and like the material if you enjoy it, to receive the latest updates.
Well, hold on a minute. Gold's a bit expensive now. What? $3,500 an ounce? That tiny little fleck of and silver. I can buy a sack of it. I can buy a load of old quarters from 1935. And by the way, if the world did end, I can go to my neighbour and say, "See that chicken? I've got a silver quarter for you. I'll buy it." You can't do it with gold coin, can you? So anyway, the old currencies apply. But silver, see, gold back in the day was not money, it was currency. You have a few gold coins, you put them under the floorboards. It's not everyday money. You don't walk around with it. Now, if you think about gold, silver, copper, gold is for your cash, your wealth, or whatever counted for banking. Actually put it in a bank, literally, bury it underground in the corner of your house. That's how they used to do it. Silver, now that is purse money, that's wallet money. You carry that in a little sack which you tie to your pants. Okay, right. So you don't really lose it because it's in a purse. You might bury the purse if you're having a problem. It might split. It might all fall out. That would be a pain. But you put the copper in your pocket. That is pocket money. So you've got pot money, purse money, and you've got pocket money, right? Which is why if you go treasure hunting, you will find infinite quantities of copper because it was in the pocket and easily lost.
Right.
Yeah. So that is the hierarchy of metals. Yeah. So gold is for cashing. Silver is for high-ish value transactions. Yeah. So that's why it's retail. That's another reason it's retail. So anyway, a retail looks in and goes, "Look at that gold go. Oh, I'll buy silver." And that's what you're seeing now.
Right.
So you're seeing retail catching the wave. Yeah. Which is driven by governments buying gold. In the old days, your investment banks will go, "Hey, gold's going on a run. We're short that. We're short that. We're short that. Oh yeah, we manipulate the price." And retail will go, "Oh no, I'm losing money. I'll sell. Oh, I'll take it back. I'll take it back." And and the institutions can do that with retail because retail is there's always the frothy part of retail that is easily manipulated, but they can't do that to government. That's that's playing that's wrestling Godzilla. You are going to lose. Right. So they have to get out of the way of the price. The price is running. Now silver's running. Yeah. So that is what's going on. The question is, where's it going? And when I look, when is the situation with America, which is effectively saying it's on the warpath?
Right.
Yeah. China's saying, yeah, we're just growing. We're growing. We get bigger and more powerful. We've got 4 times more people than you. And give us 10 years, we'll have as much money. So we'll have 4 times as much money as you. We're the superpower now. And America's going, hold on a minute. No, we're in charge here, and stop that. Stop that getting richer at our expense. No, we see you now. We know what you're doing. You're going to stop that. Well,
Clem Chambers demonstrates that China under Xi has shifted from cooperation to confrontation, reviving Maoist ideas, discouraging Western influence, and asserting power over Taiwan. This has fractured global supply chains, turning critical resources like rare earths and cobalt into weapons of leverage. The U.S. is responding by rearming and rebuilding industries like shipbuilding, which are essential for military strength. Strategic reserves of gold, silver, and critical materials are becoming vital as global trade routes grow more fragile and politicized. Clem emphasizes that this dynamic is reshaping geopolitics. America is pressuring Europe to rearm while also courting India to counterbalance China. Russia, though armed with nuclear weapons, lacks the economic weight to compete. China, however, is a true rival, with far more financial resources and technological capacity. The global stage is being redrawn into blocks, and for ordinary people and markets, the consequences mean heightened risks, disrupted trade, and the urgent need to secure assets in times of escalating conflict. Let's redirect our attention towards the interview.
Xi came in to China and brought back Maoism, which is not good. He said to his children, stop playing computer games, start getting fit, stop learning English, hey, Taiwan, we're coming for you.
Right.
Well, that's what kind of started the ball rolling. Yeah. Now, their predecessors were much more, we'll be your friends. We'll make your plastic junk. We'll make money. And we'll all be very civilized and nice. And, we can all be friends. But Xi has taken a China exceptionalist point of view in the same way as America takes an American exceptionalist point of view.
Right.
And in fact, the world needs to be more like the Europeans who up until recently have been quite laid back. We can get on with you. Yeah, build a pipeline. Yeah, let's all do business. Yeah, let's all be friends. Well, that polarity means that all these global supply chains are now fractured. Yeah.
Right.
So you can't actually rely on your cobalt flow anymore or your rare earths anymore. And that's the base of your economic pyramid. And whereas before they were commodities and they just got loaded up to ships and sent to wherever they needed to be, and everybody was, relatively reasonable with each other. Now it's like, oh no, you can't have your rare earth. No. We've weaponized it. No. See how far you're going to get with your business without our rare earth. Oh, cobalt. No. So now countries basically have to build up strategic reserves of all sorts of critical things. And silver is good. You start by going, the only thing we need is gold, because gold, that's bullets, and we can buy everything we want with gold. And then you go, actually, maybe we can't. Maybe we won't be able to buy it all. Maybe we won't, if they're shipping it, and they say, no, if a ship goes there, we're going to sink it. I mean, what's been going on with the Houthis? They've been firing at ships. The thing that happened also, that is, I had to check up to see whether it happened, and it actually happened. Trump came out and said, if you've got a Chinese ship, and you land containers, we're going to bill you. We're going to bill you 2% of the value of those containers when you land. So if you're a container ship built in China, that's a $7 million bill just to pull up at the port.
Wow.
Yeah. And that's so that people buy American ships, not that America makes many ships just yet, so that the ship industry in America will take off again. And why do they want shipbuilding in America? Well, if you can't build ships, you can't build battleships, can you? Yeah, you can't build all those Liberty ships that were built in the Second World War to ferry all that important equipment around the world as you're fighting World War III.
Right.
Oh, oops, I can't build ships. Oh, well, actually, maybe we'll build a few shipbuilding. Oh, I can't build ships because I haven't got any iron. Oh, still. Oh, no, and I haven't got any I've got no rare earths. I can't build any planes. Yeah. So that is what's driving all of this. It's basically America rearming.
Wow.
And yeah, exactly. And it's not good. It's like, okay, you could say they have to, they need to, they must. Okay, I'm not going to argue with that. But what that actually means in reality to people like us, and to the markets and to the world economy, and what is the denouement on that? Normally, these things don't suddenly heal themselves and everyone's friends. That is dramatic, absolutely dramatic. And that drumbeat, I mean, when they had that speech in Europe, it was like, oh no. And then you go, well, I'm just being paranoid. I'm old and I'm paranoid. Oh no, they've done something else. And every dot on the map, it only makes sense when you see it as America rearming.
Right.
And they've told Europe to rearm. And Europe is rearming. Well, that's not good. I mean, okay, forget it. Maybe it's great. I mean, maybe I'll be, old enough I won't care that there's World War III started. But maybe I'll make so much money I'll be in Chile, I'm drinking red wine, crying, but I'll be far away. But nonetheless, it's not, I can't change that. The only thing I can do is look at it and see where there's real returns to be made to secure myself and my family. And that's how I look at it. It's, I can't, maybe it's necessary to have World War III. It's nothing to do with me. I can't affect that in any shape or form. But there you are. There is that drumbeat. And they might stop. After all, somebody wants a Nobel Prize. Maybe China does is too fragile to get into this Cold War conflict. Maybe it's, Russia versus America all over again. Maybe it
Right.
isn't, whatever, but if you don't realize what appears to be going on, you don't track it, and you don't, something that is, I was relieved a few weeks ago. Trump was getting angry at India, at Modi.
Yeah, I heard about that.
Yeah, but you realize the moment America starts sucking up to India, that is very, very bad. Because in a global conflict, it's China, India, Russia, and America, and Europe, right? India is a major player. Now, they historically go, nothing to do with us. No. Nothing to do with us.
Right.
Nothing to do with us. But if America is really accelerating, it has to make India either neutral or their friend. Because then it's China and Russia. Well, Russia's nothing. Everybody's worried about Russia. Russia's 150 million people with no money, right? China is 1.n billion with all the tech that we love.
Wow.
Forget Russia.
Yeah.
Russia is, not a thing really. It can nuke everybody. That's the thing it's got. But you take away its nuclear, what has it got? It's got no money. It's got hardly anybody. Yeah, 150 million people versus 500 million people, $7 million GDP versus a $35,000 GDP per head. It's like
Wow.
1/18 of the economic power of Europe,
Yeah, it's a
without
big
even
difference.
factoring America in there.
Yeah.
But China's a different matter. China's got more money, literally more cash. In dollar terms, it has got twice as much cash in dollar terms in America.
Wow.
So if you counted up, if you stacked up all its yuan, and you said that's that much of dollars, and you stacked up all the American dollars in existence out there in circulation, it's got twice as much. Yeah, you fly into Shanghai at the airport, and you fly into JFK, and you think these JFK versus Shanghai airport in a battle. There's only one winner there.
In short, the world is entering a new era where gold and silver are not just investments but lifelines in a fractured global order. As nations rearm and tensions rise, precious metals are gaining renewed importance both for governments seeking power and individuals seeking protection. The momentum in these markets reflects not just financial trends but deep geopolitical shifts that will shape the decade ahead. How long can central bank demand continue driving gold and silver higher before retail investors face a major correction? Could rising geopolitical tensions accelerate a shift toward a new monetary system backed by precious metals? We'd love to hear your thoughts, so share your comments below. Don't forget to subscribe for more content and hit the like button if you found this video valuable. Thanks for being part of this journey with us.